Most people think investing is about predicting the market, chasing hot stocks, or finding the next big thing. Warren Buffett disagrees completely. For more than 6 decades, he has repeated the same simple ideas again and again while the world ignored them. In this video, we are sharing 10 investing lessons from Warren Buffett. Lesson number 1. Invest only in what you understand. Warren Buffett has repeatedly said, never invest in a business you cannot understand. He believes investors lose money not because they are unlucky, but because they invest in things they do not truly understand. Buffett avoids complicated businesses, new technologies he cannot explain simply, or industries where future profits are unclear. He focuses on businesses with clear products, predictable demand, and simple economics. According to him, you do not need to know everything in the market. You only need to know a few businesses really well. If you cannot explain how a company makes money in plain language, Buffett would say you should not invest in it. Understanding reduces emotional decisions and protects you from hype-driven losses. Lesson number 2. The stock market is a tool, not a shortcut. Buffett famously said, "The stock market is a device for transferring money from the impatient to the patient." He does not see the market as a place for quick wins or fast money. He sees it as a long-term ownership tool. When stock prices fall, most people panic. Buffett sees it as an opportunity to buy good businesses at better prices. He explains that market prices move for emotional reasons, not always because business value changes. If you treat investing like a quick money activity, emotions will control your decisions. Buffett teaches that patience, discipline, and long-term thinking matter far more than timing the market or predicting short-term movements. Lesson number 3. Buy a business, not a stock price. Warren Buffett often says he invests as if the stock market will close tomorrow and not reopen for years. This mindset forces him to focus on the actual business, not daily price movements. He looks at earnings, cash flow, competitive advantage, and management quality. Price matters, but only in relation to business value. Buffett explains that a great business bought at a fair price is better than a fair business bought at a great price. When you think like a business owner, short-term volatility stops bothering you. You care about long-term performance, not daily headlines or market noise. Lesson number 4. Long-term holding is a powerful advantage. Buffett has clearly said, "Our favorite holding period is forever." He believes frequent buying and selling increases mistakes, taxes, and emotional stress. When you own a great business, time becomes your biggest advantage. Compounding works best when you stay invested for decades. Buffett explains that many investors underestimate how powerful steady growth becomes over long periods. He prefers businesses that can grow earnings slowly but consistently. Holding quality companies allows you to benefit from reinvested profits, brand strength, and market dominance without needing constant action. Lesson number 5. Risk comes from not knowing what you're doing. One of Buffett's most misunderstood quotes is, "Risk comes from not knowing what you're doing." He does not define risk as price volatility. He defines it as the chance of permanent loss of capital. Buffett explains that if you understand a business well and buy it at a reasonable price, short-term price drops are not risky. Real risk comes from speculation, leverage, and blind confidence. He avoids debt-heavy businesses and investments that rely on perfect conditions to survive. Knowledge, margin of safety, and discipline reduce risk far more than diversification alone. Lesson number 6. Price is what you pay, value is what you get. Buffett has often said this simple line to explain investing mistakes. A low stock price does not always mean a good deal, and a high price does not always mean something is expensive. Value is based on future cash flows, durability of profits, and business strength. Buffett looks for businesses that generate consistent cash over long periods. He explains that paying a fair price for a wonderful business is smarter than paying a cheap price for a weak one. Understanding value helps you avoid emotional buying during hype cycles and fear-driven selling during crashes. Lesson number 7. Economic moats matter more than growth. Warren Buffett talks a lot about economic moats, meaning a company's ability to protect profits from competitors. He prefers businesses with strong brands, customer loyalty, cost advantages, or network effects. Growth alone is not enough if competitors can easily copy the business. Buffett explains that a strong moat allows a company to raise prices, keep customers, and earn high returns over time. He looks for businesses that will still be strong 10 or 20 years later. A durable moat creates predictable earnings, which makes long-term investing safer and more reliable. Lesson number 8. Management quality is critical. Buffett has said that even a great business can fail with poor management. He looks for managers who act like owners, allocate capital wisely, and think long-term. He dislikes executives who chase short-term stock prices or personal rewards. Buffett respects honesty, discipline, and transparency. He has explained that trustworthy management reduces surprises and protects shareholders. When management reinvests profits intelligently or returns excess cash to shareholders, long-term value increases. For Buffett, good leadership is not about charisma. It is about integrity, competence, and rational decision-making. Lesson number 9. Do not follow the crowd. Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." He believes crowd behavior leads to bubbles and crashes. When everyone is optimistic, prices often become disconnected from reality. When fear dominates, good businesses get unfairly punished. Buffett explains that independent thinking is essential. You must be comfortable being different. He avoids popular trends and focuses on fundamentals. This mindset allows him to buy when others sell and stay calm when others panic. Long-term success requires emotional control and confidence in your analysis. Lesson number 10. Simplicity beats complexity. Warren Buffett has repeatedly shown that investing does not need to be complicated. He avoids complex financial products, excessive leverage, and unclear strategies. He believes simple ideas executed consistently outperform complicated systems. Buffett explains that many investors fail because they try to be too smart. Instead, he focuses on basic principles. Understand the business, buy at a reasonable price, hold long-term, and stay disciplined. Simplicity reduces mistakes, stress, and emotional decisions. Over time, simple strategies compound quietly, while complex ones break under pressure. If you found this video helpful, then like, share, and subscribe this channel to get more videos. Thank you for watching this video.